It's been a fantastic year. I mean, you have the S&P up over 17% after we already had 2 years of 20+% returns. So certainly we want to make sure that we're taking time to rebalance them as we head into next year, making sure that we have diversified portfolios. I mean, the technology and AI-driven momentum we've seen has been incredible, and we certainly want to keep exposure in those areas. But we also want to make sure that we have exposure to other parts of the market and, within equities, outside of equities, and are rebalancing some of those exposures from those areas that have done so well, just to make sure we're positioned for whatever comes next.
So RaeAnn, S&P 500, as you said, up about 17% year to date. Having said that, there's still a lot of cash on the sidelines. So what do you do if you're one of those people with that cash? Is a down market, when it happens, a buying opportunity, do you think?
We would view a pullback as a buying opportunity at this point. I mean, there are still so many reasons to support why the market can continue to move higher. But if we do get volatility, that could be a buying opportunity. And you do have so much cash still on the sidelines with investors who are waiting for that opportunity. So we do think that would help to prop it up if we get a pullback. But we would recommend that you just come up with a plan and kind of put a little bit of that to work, maybe once a month, every couple of weeks, just to be more disciplined about it. In case you don't get that pullback, then you at least are able to get that exposure and edge into the market over time instead of continuing to sit on the sidelines and miss all of this great returns that we're seeing.
RaeAnn, we've also had some pretty solid returns in the fixed income markets, particularly for those who want to take some credit risk here. What's your fixed income call these days?
I mean, for our clients that have fixed income as part of their strategic allocations, we've certainly stayed invested in that area. We have had a little bit of credit exposure outside of our investment grade allocations, which are primarily municipal bonds. But with spreads as tight as they are, we don't want to take too much risk in that area. But we do allocate, to high yield munis and look also as well to private credit markets and credit-oriented hedge fund strategies to complement the returns that we have in our traditional fixed income portfolios.
RaeAnn, how exposed are you to the AI trade right now? And what are you telling clients who are like, I don't know if I want to get in any more than I'm already in?
And if you have any exposure to U.S. equity markets and S&P 500, obviously you have a pretty strong allocation to the mega cap tech players that are driving a lot of that trade. So we certainly have exposure there. And we do as well. We've made some investments within private equity and venture capital funds that have exposure to some of those themes as well. And we do think that this is really a transformational point in the cycle where these companies are going to be changing the markets, changing the world, and the way we all operate. So we do want to have exposure there, but again, just making sure that we're trimming profits, periodically doing some rebalancing, but keeping that exposure because we do expect that will continue to be a tailwind as we see more and more companies adopting into AI technologies and helping them improve their productivity and their businesses in a number of different areas. It's just going to be a tailwind for a long time to come.